Hey everybody, this is David Skarica. I just wanted to quickly do our stock chart of the day here. This is August 2nd, 2024. So uh, so today we're going to look at interest rates. Tomorrow we're going to look at the US dollar. So it's kind of interesting that I decided I was going to do Tuesday and interest rates. I'd planned that on the weekend, and it's kind of a key day now. It looks like it's happening. Obviously, this is pre-market. I'm doing this at 9:24 a.m. Market opens in 6 minutes, but we can see the TLT is down 90 cents pre-market to 91.60. And if we go look at the TLT, you can see that's about the lows of February. And if we break those, that's the lowest level since last December. So I think that the long-term bond is going to continue to move higher in yield. If we go look at the Fed funds futures, which I quickly looked at yesterday, we're now looking at about a 50-50 chance for June. And you can see it's 70% chance that in July there'll be the first rate cut. And then September now is this would be two rate cuts here, is at 54%. So only about 50-50 chance in September of two. And December, which was looking at 3 to 4 rate cuts just like a few weeks ago, is now looking at again about 54% for the 3 rate cuts. So again, 50-50 for 2 to 3. So we've gone from 5 to 6, late last year, to 3 to 4 to 2 to 3. So I think they'll still do 1 or 2 rate cuts, but I think the issue we're going to see is, we're seeing commodities move higher in price. Oil is up to over 86 today. This is oil K, because this will show, you can see it's up another percent. So we can see that. And if we go look at Texas crude, you can see the move here. And now we're up to, we're up to over 85, 86 now this morning. So we're about here. So, again, we're kind of getting back to almost getting closer to the September highs and the lows back here. And I think one reason is, the supply demand for oil isn't the greatest right now, but I think probably one of the issues is they really stopped selling the strategic reserve. And I told people that made a big difference. You may say, oh, it's only whatever, a million barrels a day, but it's 1% roughly of global supply. And a market like oil, where just if it's off balance by 2-3%, it makes a huge difference. That 1% a day not coming out is just a huge deal. And I think we're seeing that, and this is with a stronger U.S. dollar, which we're going to talk about tomorrow. But anyhow, today we're going to focus more on interest rates, and we can see here. So I just wanted to show oil because that's another inflationary pressure that's happening here, and you can see interest rates are going higher. We had strong manufacturing on Monday, so the economy is not really slowing that much yet. So this is another reason, I think, and as I've noted all the time, that in 1987, and that should be another stock chart of the day for the future. I'm going to show you what happened in 1987 and what the market would have to do to kind of trade similar to that. Maybe I'll do that later this week. It would actually mean that we would start a correction pretty soon and then have another move higher into the summer. But we'll talk about more in detail another time. So we can see that in the TLT, and we go look at the TNX, which is the 20-year bond or the 10-year bond yield. You can see it actually does show the pre-market trade at 9:27 a.m. And again, it has broken out, above this high here. See, I thought this high was gonna, like in March, I thought this high was gonna hold. And now, and here, and just a few weeks later, I was like, nah, I don't think it is gonna hold. And it's not. And so I've been talking, that's why I've been talking about it. So one thing trade you could look at, I don't own it, is the TBT. That's going to start breaking out today. I've talked about my big short trade. For those of you who don't know, you could just type in, I don't know, like stock chart of the day, the big short, or LQD, stock chart of the day, LQD, and you'll find it on my page. I've talked about it in the past. Maybe I'll do another video on it as well. And it's because it's investment grade, shorting investment grade uh, uh, bonds, corporate bonds, because usually they're very secure, but they have so much debt that if interest rates go up, I think if interest rates went to normalized levels, meaning like 6-7% on the 10-year bond, something like 3/4 of investment grade bonds would actually be junk because these companies have so much debt on their balance sheets. So that's the issue right now. So investment grade bonds really shouldn't be graded as investment grades, just like AAA, subprime mortgage packages mortgage-backed security shouldn't have been. So that's kind of my thesis behind this being a great short. And actually, I just found a stock today that's a highly leveraged finance company. This is for paying members only, and I'll talk about it today. I'm going to do a quick PDF. I'm not going to do a video update, or I might do actually even a quick. I haven't done one in a while, just a podcast update with the chart of it below. So watch that. Watch out for that for paying members. But I think I'll do one of the two later today. And I think this stock could be an excellent short because it's a highly leveraged finance company that when the market corrects like 20 to 30%, this company goes down about 50%. So of course, if we were to have a correction or bear market larger than that, this would go down a lot more. And you're not going to have the premium or hype in something like Nvidia, the options, or like just hype in the stock in general in that. So I just wanted to show this. I think this is very interesting that again, the market continues to price in less interest rate cuts, and we're seeing this breakout in yields. Like let's go look at the short-term yields really quickly as we finish off here. And they have come down. So they've come down from 534 to 521. So that's 15 basis points, but they're still in the middle of the, well, now they're below the 525 to 550 range. I shouldn't say that. So they're starting to price in that first rate cut, but again, they're on the kind of lower side of where the interest rate is now. So I would think that, when we go to 525, this should be about, 513, like down here. So that should be the next move. So, but I don't know if it's going to happen in June now. I suspect that we'll get one or two rate cuts. And then I think the problem is going to be, because we're already seeing inflationary pressures build again, those rate cuts could cause them to build even more. And then the Fed might want to have to reverse course and say, okay, the rate cuts are off now. And of course, all that debt's going to hit the market at the same time, et cetera. And I think that's really the bind they're going to be in. I think ultimately what's going to happen is they won't be able to cut rates a huge deal because inflation is kind of like at a higher permanent level. But they can't let yields get too high because the government debt is so high. So they're almost going to be having to do QE or monetizing debt at the same time when they have to keep interest rates at some sort of level, to try to keep inflation down a little bit. So I think that's going to be the ultimate problem they're going to have. And that's when they're going to be trapped. That's something I've been waiting for almost 25, 30 years to happen, but we haven't seen it yet. So that's today's stock chart of the day. The TLT looks like, look, it's just turned 9:30 as I'm doing this. So let's go look up the TLT to see where it opened. Opened down almost $1, down 97 cents. And you can see we kind of broken those lows. I don't think we haven't done it significantly enough. I think a break below 91 would really signal that. And of course, now we're again below the 200-day moving average, which for the most part has held a couple small declines below it. But in terms of percentage below the 200-day, this is probably the most we've been since this market was in a downtrend last year. So TLT breaking down, interest rates moving higher is today's stock chart of the day.